Good morning, everybody, and welcome to the Allsop auction webinar. Those of you that don't know me, my name is Richard Adamson. I am one of the auctioneers and a partner in the residential team. And with me today is George Walker, who is likewise a partner and auctioneer, but in the commercial division. So just by way of an introduction to the agenda today, to let you know what we're planning to do, we're going to talk fundamentally, first of all, about the switch we made about a year or so ago, which George talked about. We went from the ballroom auctions to online only auctions, which is no mean feat. And then we will look back over the past 12 months in both sectors as to where the market's been. It's been an interesting time for all of us, and I think we've got a good insight into where the market's been over that period. And then both sectors, commercial and residential, George and I will look ahead as well and try and give you some predictions and some ideas of what we think may happen in the future. And the whole way through the webinar, please feel free to ask questions. You'll see an icon at the top of your screen, which is a speech bubble with a question mark on it. If you click on that, you can submit questions to our colleagues Zoe Baxter and Ben Hodge, who will answer them. Some of those will be answered live straight away as you send them through. Others may be held back and they'll be asked to George and I afterwards to speak to everybody about. So that's the format. So please do feel free to ask questions throughout the webinar. And first things first, before I hand over to George, who's going to talk about the switch from ballroom to online auctions, I want to give an idea as to what qualifies us really to talk about what's happened over the past 12 months in the property market. It's just over 12 months since the first lockdown. It seems like a long time ago now, but it's only 12 months ago. And in that time, we've held a total of 17 online auctions between the two teams. We've sold 1,850 assets, and that's rising every day. And that ranges from property prices from £1,000 to £10.5 million. In total, during that period, we've raised about 840 million. So it's a real wide spectrum of property types that we're selling, and it covers the whole of the UK as well. In terms of the profiles of the sellers that we act for, again, it's vast and varied. It's banks, receivers, administrators, councils, housing associations, funds, institutions, property companies, executors, charities. The list is endless. So it's a real wide spectrum of sellers as well as property types and values. Right. So that really does provide us with a very unique insight into the market, and more importantly, in a 12-month period where it's very unpredictable and turbulent at times, that snapshot 17 times a year as to exactly where the market is, exactly what buyers want, what they're buying, what they're not buying, and where pricing points are, is a really good position to be in, and we want to sort of share some of that with you. So for now, that's it from me. I'm going to pass you over to George, who's now going to talk to you about, as I say, the switch from ballroom to online auctions. Over to you, George.
Many thanks, Richard. Good morning, everybody. I'm George Walker, one of the commercial auctioneers in the team, longing for my ballroom. So, online, we had to go online. There is nothing like a burning platform to make these things happen. We had a system, we had prepared it 2 years earlier. We'd done 2 online auctions and we were ready. February 2020, we discussed it. March 2020, you remember it was Cheltenham week, second week in March when it got very serious. In the third week of March, we decided to go online. At that point, we had 2 auction catalogues out, old-fashioned paper catalogues, and 2 ballrooms booked. We had the Boris bounce to fill those catalogues. Richard had 300 lots in his catalogue. It was a big sale. You remember Boris 1, everything was gearing up for a big year, but it was quite a big job to get it sorted out online, but we did it in less than 10 days. We changed the date slightly and we ran 2 successful auctions. The biggest lesson, I think, was digitalisation was imposed on our market, us as agents and buyers and sellers alike. And we really feel the age arrived. People suddenly worked out that from their desktop, they could do 3D tours. They could look at every legal pack they wanted. They could look at all the DD, and they could do a lot of preparation. In fact, they couldn't get around the country. They couldn't go and see properties, and it didn't seem to deter them from buying. I think that we probably had to do 3D tours for 10 years from our phone, but suddenly everyone was doing it and really sweated that tech, and it's worked incredibly well. As auctioneers, the unconditional contract has always been central to our process. It's been there in a case central to it since 1847, and could we keep that contract unconditional? Well, we have. It remains unconditional. When the digital hammer falls, it is binding on both the buyer and the seller. The sellers clearly like it because it gives them an end date. The buyers like it too because it's been a tricky market, and there's been lots of strange deals going on, but the buyers know when the digital hammer falls, they have the asset. The only real change is that because of the AML, the money laundering regulations that ran alongside the beginning of last year, we have to register all the buyers. And we've now changed it so that if you want to bid, you put £10,000 bidder security per property with us and top up the full 10% within 24 hours. Again, it was very welcome by everybody. The registration process was a bit tricky, but we got it done, and it's now accepted and working very well. And we've tested it, and it works. The one thing it's allowed us to do is have more auctions. Richard's had 17 auctions. We used to have a calendar of 6. We've now got 8 in commercial team. Clearly, there are auctions. There are a lot of auctions which are much smaller in terms of lot size, and we've consistently stuck it in my team, 8 and Richard, 9 auctions, and it seems to work with similar lot numbers in bulk auctions. But the chance to change dates and be flexible without worrying about hotels and other things has been very welcome, and we've taken advantage of it. So I'll pass you back to Richard now to look at the resi market and how that's fared over the 12-month period.
Thank you, George. As the slide there says, looking back, I mean, that's what my intention is to do for the past 12 months during the lockdown. But before I do that, I think it is important to remind ourselves where we were just prior to going into lockdown and the pandemic hitting us. Is that we'd been through a really turbulent time, certainly in the resi sector, whereby we'd had 4 years of political uncertainty with Brexit, elections, referendums, you know, and that really did cool the confidence in the market month to month, year to year, in terms of buyers waiting and sellers waiting to take the plunge. So there was, when we got to the point of a general election, a landslide victory and some certainty, and in particular the Brexit certainty, there felt like there was a lot of pent-up tension, a lot of demand there that wanted to be fueled. So we were all rubbing our hands, expecting quite a busy time over the next year of 2020 into 2021. So there was that there before, and then of course the pandemic hit. So in terms of the 3 points I've got there, it's the immediate impact of COVID, the mini boom and the post-budget hiatus. Well, the immediate impact is reasonably obvious, I suppose. We had, as a firm, 364 properties out to the market. The residential one was, 464. Residential was 300 lots. And understandably, there were a number of sellers that were very apprehensive and nervous about that. Was it the right time to sell? We had a week to turn to going online. The market was uncertain. The whole world was uncertain. So as a consequence of that, we went from 300 lots and having 100 or so lots withdrawn from the auction from some sellers that were nervous rather than there being a lack of interest. But conversely, the demand and the calls and inquiries we were getting didn't change at all. You know, we were getting huge volumes of calls the whole way through that very first period. In fact, we probably averaged during our marketing campaigns of around about 400 or 500 calls a day. That was up to 800 calls a day. So the demand was huge. And in part, that was due to the fact that high street estate agents were closed. A number of other auctioneers didn't have online platforms, so they couldn't transition to that platform. So there was less stock out there, and we benefited from that a lot. So the March auction was reasonably successful in the circumstances, raising £30 million, and we sold 160 odd lots. Then we moved on to May, and that was interesting in itself as well. That was the first time we had to put together a catalogue post-lockdown. So again, we were experiencing some vendors being nervous and wanting to wait and see, which again, completely understandable. We still managed to piece together a 200 lot catalogue, sold £35 million, and again, success rates hovering around the 90% mark. Again, buyer demand was huge. You know, the supply was the issue for us. You know, getting supply, demand wasn't an issue, and that was really strange and really surprising in many ways. But by the summer, you know, the market seemed to have, or certainly the market in terms of the sellers, the confidence had grown and the nerves had settled a touch. And that's probably because they're witnessing the prices that we were achieving and the demand that was out there, and they wanted to obviously join in and actually benefit from some of that. It's also worth bearing in mind, as we went into July, there was a stamp duty holiday was introduced, and that was obviously designed to stabilise the market, but if anything, it fuelled it further. And then we had obviously the stability that furlough brought to the wider economy, and that had an impact on confidence in the market as well. So as we moved into the summer, from June through to Christmas and then afterwards into February, so for a long period there, we experienced a mini boom, which was extraordinary and something completely unexpected. And again, the demand was very strong across most sectors within residential and most regions, with, you know, supply really struggling to keep up. So the 5 residential auctions we had from July through to February were all larger and more successful than the year before. And across that period, the amount we raised was 21% up on the year before, which, had you asked me that back in March at the beginning of the pandemic, I would have laughed at you, and it was extraordinary to see that. Don't get me wrong, some of that demand and activity was being driven by stamp duty, but I think it's important to say, as I mentioned at the beginning, is that there was a lot of pent-up tension prior to the pandemic, post-Brexit and post-election. I think that was still fueling it in many ways. And then we move on to the third point, which is the post-budget hiatus. We experienced right towards the end of 2020 some real urgency out there, and it was reasonably well publicised that solicitors were struggling to get completions done in time, and the workloads were well manageable for a lot of them, with people trying to buy before that stamp duty holiday ended. And then we got to the budget, people were waiting, hoping the rumours were true, it was extended, and it was extended. Now, what impact did that have? It kept the demand pretty steady, and it took some of that unnecessary urgency out of the market for both sellers and for buyers. So the market really has been pretty strong, and we've levelled it out as a firm. We've had more auctions spread out to try and meet some of that and actually pick up more of the lots as the year goes on. And then if we move on, so what we experienced, I think it's quite interesting to look at what the whole wider market in the residential sector experienced as well. And I won't read all those stats to you, but I think what's quite important on those is that, as you can see, the indexes of Land Registry, Nationwide and Halifax broadly say what I've just described, in that beginning of this year, January, February, March, there were slight reductions in the average prices across the UK. But year on year, they've looked at anywhere between 5.2 and 7.5% house price increase, which is, like I say, extraordinary when you think where the market's been and what the world's been through. And the final interesting, I suppose, statistic on there as well is to look at how quickly sales are agreed for estate agents as well. It looks as if, from the Rightmove, they say the average time to agree a sale in February 2021 was 60 days compared to 67 days at the same time last year. And the peak, as we all experienced running up to Christmas, was October, 49 days to agree a deal. So those high level stats support exactly what we experienced in the auction market. So moving on to looking forward, now that is very much crystal ball time. It's hard enough to predict where the market's going to go at any time, let alone coming out of a pandemic that no one's experienced before. But I think there are some three important factors to look at, and they're economic factors that are going to have an impact and decide to a degree where the market goes from here. The obvious one is the stamp duty holiday. In England and Northern Ireland, the tax-free threshold of £500,000 will remain until the 30th of June. Between the 1st of July and the 30th of September, the threshold will be reduced to 250,000 before returning to its previous level of 125,000. Now, that will have an impact on confidence generally in the market, but it will probably also have encourage a little bit of a price correction whereby buyers are paying more because of the tax, and they may adjust what they're prepared to pay for assets. But it's not a huge reduction in the scheme of things. You know, we certainly noticed when it was introduced, the prices were going for more than they were saving in terms of the actual tax saving they were making there. So there's still plenty of confidence there, but that will impact, I think, slightly the market. The other obvious one is the furlough scheme. Now, that obviously has wider implications for the economy as a whole, and that won't be ignored by the residential sector for sure. It ends on the 30th of September 2021. It seems inevitable there will be some increase in unemployment as a consequence to that. It's hard to say how much that will be, but that should and may well impact on the residential market. Private tenants may struggle to pay rents. That will put some pressure on some private landlords as well, and that may encourage some sort of foreclosures and issues like that, which could impact the market confidence-wise, but also increase the stock levels that are being sent out to the market. In reality, we're probably not going to see that sort of thing until towards the end of this year and Q1 next year, but it will nevertheless probably have an impact. The third one on there is lending sentiment. I'm conscious I'm talking to people that know more about lending than I do, but it is important to point out that mortgage availability was hit hard during 2020. In particular, the availability of products to first-time buyers wanting to put down a deposit of less than 10%. In fact, it actually filtered into the 10% bracket as well. Now, although those buyers with deposits of 5–10% have been the hardest hit during the pandemic because a lot of these products were withdrawn, first-time buyers have been handed a boost last week as the government introduced the 95% mortgage guarantee scheme. Too early to say how that'll impact, but it could be a positive move. And that sector is really important. If we can get the bottom end of that food chain moving in terms of buyers, it underpins and it has a knock-on effect throughout the property market up the chain. So it's really important that does work. But, you know, again, from a high level, it's important to point out, you know, that overall average rates have been on the rise in the last 4 months, but they still remain lower than pre-pandemic levels. So money is there, money is available, and that will fuel and drive the property market. The final thing on there, which I haven't put down, is to observe is foreign travel. I think that will have an impact if that's eased as we come out of lockdown. Obviously, that impacts on the leisure and the tourism sector in particular. But when you look at the central London market, there is a lot of money historically has been put in by foreign investors, and I think as travel gets eased and more people have to travel freely, that can only be a good thing for the central London market. So that could pick up as travel becomes easier. So watch this space in that sense. And finally, before I hand you back to George to talk about the commercial market, I wanted to just touch on some. We can move on to the slides there, to shift in demand, buyer behaviours and some sort of trends that we've noticed. The first one is well publicised, we've all probably read about it, but it is true, we've seen it. Towns and cities, yes, people still want to live there, but there has been a shift for people wanting to move further out into suburbs and further afield to get better space, to reflect their change in their life, their working circumstances and flexible working conditions. So bigger spaces, gardens, parking, spare room, office space, that kind of thing. We have seen that shift. The towns and cities are still strong. There's always been plenty of demand there, but it is filtering out to some of the commuter belt towns as well. George will talk about this later, so I won't go into too much detail, but there's always been, and there's a strong demand, certainly over the past 12 months, for what we call demand for value-add opportunities. It's assets or properties where you can buy it and add some value yourself, whether that's by planning, whether it's by modifying, asset managing. People like to buy these sorts of things in reasonably uncertain times because they can spend their time adding value rather than waiting for the market to assist them. And then the third point there I wanted to talk about was some trends we've noticed. Historically, when you sell things at auction, and I'm talking about granular products here, single units, houses, flats, or smaller blocks, but not larger blocks of flats. More often than not, there is a preference from investors to try and buy properties that are tenanted, for the reason being that they want to hit the ground running with immediate income rather than immediate void periods. We've noticed a bit of a shift in that now during the pandemic, and there seems to be, from the smaller investors and amateurs, a real interest in buying them vacant. And the reason being is they want to be able to control the quality of their tenants, and inheriting tenants without some background as to what those tenants are like has risks more so than ever. It's also from a point of view of simple marketing. We can conduct viewings on vacant properties, tenanted ones, harder than ever with COVID, people not being so comfortable to open their doors to viewers. Things that are here to stay that we've learned over the 12 months, and George mentioned that about our shift to the online platform. The reasonably obvious things now really to everybody is that most, if not all, our properties have video tours, virtual tours, internal photographs of high quality, floor plans. That's here to stay. Buyers demand that, and we've really noticed a shift in how people will buy without visiting the property if you provide them with really good quality information so they can make an informed decision. And the same apply, legal packs haven't changed over the years, but it's important to stress that buyers want information and detail, warts and all. Properties have problems, that's fine, as long as people know what those problems are so they can build that into what they're prepared to pay and they're not going into it blind. So that's almost it from me. I think just to say, in terms of an overall look at the residential market, it has been a really interesting 12 months, probably the most interesting 12 months of my 20-year career in property. And if the residential market can move through that time and be up in terms of house prices and the demand that's out there, we should be in a strong position going forward. There will be bumps in the road, but if it can get through this, it can get through most things. That's it for me for now. I will now hand you over to George, who will give you a whistle-stop tour of the commercial market. Over to you, George.
Great, thanks, Richard. Interesting times indeed. I have to say, with the country lockdown and high streets closed, middle of last year was quite interesting, more than interesting. But let's have a look at what happened. I've got 650 examples to show you. I promise you I won't go through each and every one. I'm going to run through a couple of headlines, as you can see on the slide here, and then go through the broad sectors. As always, I'm happy to chat and look at data more specifically, because everyone's interpretation requirements are quite different. So looking at last year, we did more volume than the year before by a couple of million quid. Quite surprising, but I think it was because we did not stop. So we had the ability to trade, buyers wanted to buy and sellers wanted to sell. So it was very positive. To the tune, to the effect that actually the average lot size over the year increased. We did a £7.5 million sale in May in lockdown. That was done in 36 hours, unbelievably. And that theme kept increasing. So towards the end of the year, by December, we had an average lot size in the auction of £1 million. Clearly, the spread of lots is, as always, classical stops 100 grand to a few £1 million, but the average lot size did peak at over £1 million for one auction. What happened was, as we all know, the private treaty market largely went into recess for a good part of the year. It was incredibly hard to get transactions over the line in private treaty. And as a result, our team, we doubled the share of the sub £5 million secondary market from 4.5% to 9% in that 12-month period, because the system worked. Great vindication, and buyers and sellers alike, as I mentioned earlier, really enjoyed it, because there wasn't any messing around. If you were there, you were the last person to bid, you bought the asset. In terms of the sector breakdown, the majority is still retail. It's gone from about 75% down to 60%. The increase has been industrial. We did triple the industrial numbers last year than the year before. Leisure, as I mentioned earlier, we work with a portfolio of leisure assets from one particular private equity house, and we sold a lot of them during lockdown. I have one or two of those examples later on. And the other sectors, so when a lot of the core values of real estate are changing quickly, because they did last year, our buyers particularly, are very happy to look at other sectors. So medical is the obvious one, care homes, motor trade, all those sort of things, where there is a business people believe, or a tenant they believe, and longevity to the rent, or sustainability to the rent, or added value, they'll have a go. And there's a lot of money out there to spend it. Our investors are very, very responsive to new sectors. They always have. It's kind of the holy grail in our market to find something else to get into, because our investors are keen and happy to give it a go. The key is either sustainable rent or added value. So we did a survey before Christmas of our buyers and what the impact of COVID and rent moratorium, etc., and a lot of them responded. Really, the underlying issue, the underlying feedback was our investors are very long term. They saw COVID really as an opportunity where pricing adjusted and they get out in the market and spend their capital. So that was the feedback, quite surprising, and I think it will still be the same, having done a couple of auctions this year, which have been pretty positive. So let's look at the first example then. In the retail sector, one of the aspects of retail, it is no surprise that the yield differentials are enormously wide, wider than ever, and in some cases, like this first example I've got there, the shopping centre, very hard to determine. As a headline, the yield is 45% net initial. That isn't right, obviously, because the rents haven't been paid across the board. And that shopping centre is an example of how really the seller sort of kicked against the market. They wanted this asset sold, been on the market for 12 months, and we set out a strategy, as you'd expect us to, and they said, no, I know it's December, but we want to put this out in December. So we put the Coventry Shopping Centre out a few days before Christmas to a resoundingly positive market, and that went to auction in February and sold in public at £4.85 million. Competitively bid for in the room, and we learned a lot in that process, that we are very, very close to the market. So in the old days, you wouldn't have put something out with the market in December, but this stage, we're very, very close. And our market is very responsive, as I said, and they look at these things, all sorts of new money, and that shopping centre has led to 4 other sales this year, to very, very surprising depth of demand. At the other end of the retail scale, there's nice little boots there in Watford. This is part of the desire for people to invest and compete for suburban type assets where the rents are low, rents are believable. Here you've got a little tiny bit of added value potentially in the long term with Boots as a tenant, and that's down at 4.5%. So that's a really quite a punchy number for a little asset, and there was a bidding war for some time on that one. So we look at the next slide. No commercial auction presentation will be complete without C-stores. This is about an essential trader, sustainable rents, believable rents. There was no let up in demand. We all know how much more we shot more locally last time. And look at this first example in Honeybourne. You won't know it probably where that is. That's in Worcestershire. It's a lovely part of the world. Not all the income was from Co-op. The Co-op income was 2033. And again, that was 4.5% or thereabouts at the end of the day. Nice site, nice building. Great photo, Chris. But it was what people want. It's not a big lot size, £1.4 million, and there was very strong competition for that. London, Little Sainsbury's in London. Sometimes we talk down at the sort of lockups, so where there's no added value, there's nothing else to do. But this store here, Brixton Sainsbury's, been a Sainsbury's for 20 years, probably another 20 years as a Sainsbury's. It's got a new 10-year lease, and that was a half decent lot size for us, 1.94 million, and that was 4.7%. So better than 5% for a Sainsbury's, and an overseas buyer actually picked that one up on the day. So moving out of let retail into vacant retail for the next slide, and we've sold about £18 million of vacant retail, and a lot of that was non-operational banks. So these are banks that tenants moved out of and they just wanted to sell them. And some of those numbers are pretty punchy. So the first example there is in Guildford. A bank is a nicely kept, nicely looked after asset. It was recently vacant, so people know you're walking into good fabric. And in this position in Guildford, we're over £311 a square foot. Another client's got a few Marks and Spencers where Marks and Spencers have left, and this one in Buxton, the client negotiated a surrender, and the auction contract, the sale, mirrored the completion of the surrender, so the client never actually owned a vacant store in Buxton, and the market was very keen on that. £27 a square foot for a big building in a good market town where people had all sorts of different ideas. So lots more examples of retail, portfolios of Boots, portfolios of Santander, but give me a call and I'll go through them in detail. Let's have a look at leisure now. My first example in leisure was a lovely pub in Chiswick. What are the keys to this? Well, Chiswick's not a bad start. It's on the river. It's got a bit of hope value for residential there, but the lease is an RPI-based lease, 2030 there, and it's no surprise that the yield was 4.3%, £2.8 million for a pub in Chiswick. It's a pub, yes, it was shut, but it's the real estate. Remember, these are long-term investors. They like the idea of that piece of real estate. Slightly again at the other end of the spectrum, the portfolio of these regional pubs that we looked at, one down in Sussex, down in Bracklesham Bay, just on the coast, single-story restaurant, very closed in lockdown, but the market saw the length of lease and believed the rent, and I think there was a hint of a C-store opportunity on this site as well. So looking perhaps through this immediate business that wasn't paying rent to the long-term future. Again, it's a long-term basis. So moving on, the offices, probably the one of the sectors that people are unsure of, whether it's just from the City of London to the regions, but from our perspective, we're looking at smaller lot sizes, and the offices we've traded in the regions have been pretty well received. And I think the key here is where they probably offer added value going forward. So the first example there is in Farnborough. This was sold in May. Again, that's in the thick of lockdown. Better than 6% for that, £230 a foot. It was occupied, but it's on over an acre of site. So you can see that's probably going to end up in alternative use residential at some point. No auction year is complete without a trophy. And look at this building, the second example there in Windsor, opposite the gates of the castle. This was a serviced office centre. The tenant runs 7 of these centres, and this was the best performing service office centre in Windsor, and they couldn't help but outbeat the market. So they outbid the private investors. £620 a foot there at 3.6%. That's something of a record, I think, for initial yield for an office building in the auction market, but we don't often get them in Windsor. So if you've got an office building in Windsor, give me a call. The next slide covers the other sector that I briefly mentioned earlier, and it's quite hard to define. You'll know it if you see it. We sold about £51 million of non-conventional property last year. The medical sector is always top of that, whether it be a dentist or a vet or a GP centre, GP surgery. And the first one in Cricklewood, nice example where one of our clients picked this up in the private treaty market, and we sold it quite quickly at £1,075,000. That yield there is 4.4%. It's meaningful. That's a big lead. £1,075,000 for GP surgery in Cricklewood. The second example slightly reflects the Chiswick pub, but it's a long-let pub in Upminster, so the rent looked quite strong, quite frankly. But look at the lease, 2072 on that lease. It's a great postcode in Upminster, lots of real estate, and the market was at 4.3% for that. Not a surprise, but it shows you the sort of levels the market will pay for this long and believable income. That's the key. So the last example I've got there is an added value situation, and I've put a yield up there, but this is about where each buyer has a different interpretation of what they might do with the income and with the site. And this site in Ruislip we sold about 5 years ago, just next to the station. It's a lot of bricks and mortar. The clients added value with a bit of planning, and it's still a big site. So that went at 10.4 million. Overseas buyer was very keen to buy that, to the point he wrote about it in the Estates Gazette, very kind of him. But 10.4 million on the auction contract. Again, this contract works, and the net initial yield was 4.3%. So looking ahead, enough of examples for this year. The market's had a lot of assistance and intervention kindly from central government, not all good from a landlord's perspective, although the first point to make there, the relaxation of planning rules, this started in 2013 with PDR, allowing offices to be more flexible, they're going to residential, and creating Class C has been very well received. People are already pricing it in, and it will just help with planning costs, planning lag time, ultimately development costs, to help those repositioning of assets, of which there are so many on our high streets. That'll obviously help transaction levels and pricing. Furlough, Richard mentioned earlier, no one knows how it will pan out, but it is quite refreshing. In the middle of last year, everyone was predicting 7.5% unemployment come the end of this year. It dipped below 5% last week, very welcome news, and you're hoping it doesn't go back to 7.5% that people are suggesting. It looks pretty solid, vacancy rates have improved, so that's going to help people's money, paying for goods, tenants paying rent. That's what we want to see. The eviction moratorium ends in June. That'll be very welcome to some landlords. A lot of landlords have been understanding, but a lot of them have been in a battle with the can pay, won't pay brigade. A lot of you will know who we mean by that. It's been unpleasant and it's been rumbling on. The business rates I think business rates is probably one of the biggest issues affecting particularly high streets, because the landlords don't get relief, but the tenants do. That seems odd. So the tenants have had relief till July 21 this year. Very welcome, but it shows how enormous that bill is for the retail sector. It's a very big nut to crack, but we're all hoping that the government do take this chance to swing the balance of business rates away from some of those high street positions to retailers and load it on to somewhere else. Obviously online's the answer. It's a very big task. It's 31 billion raised, so it's not just a week-long project for a graduate, that one. It's a big process. We're hoping it'll happen. Looking ahead, for the next slide, I think the first point, office use is still uncertain. There's no doubt about that. It's more predictable probably in the regions than in city centres. That's been factored in the market. CVAs will continue to be a feature of the commercial sector. Looking at the response to the Clark's landlords, though, from this overseas takeover, a sale of the business has been agreed conditional on the CVA being accepted. That would have seemed unbelievable 5 years ago, and some of those landlords are kicking back on that, and it will be challenged. The landlords, of course, know all about the CVAs and what it's involved, but they do have a minority vote, which is quite a challenge. The food and beverage leisure sector will have a boost for those businesses that are able to reopen, and so we think there'll be a lot of demand there. The pub agents are saying that here's a very busy sector already. Distress selling, we're not seeing volumes of distress sales in our auction catalogues. Clearly there is distress in our market, but if you go back 10 years, there was lines of receivership sales. That hasn't happened yet. Everyone's interpretation of distress is different, and I'm talking to a lending market, so I'm very aware that you are looking at assets where perhaps the valuation has been challenged. But the point I'm making here is that the volumes of those sales haven't come forward. Those that have come forward have been pretty well received. As I said, the market has adjusted and picked up those values, some cases at new levels of pricing, but there is a receptive market, and when and if it does come, we'll expect to see that bit of volume increasing. The interest rates, we're operating in a high yield market. Interest rates are low. They're set to be low for some time. The talk of inflation, of course, we're going to have significant growth this year. That may well come into inflation, because 12 months ago we were all on our uppers. The borrowing market hasn't really responded massively to that, but again, I'm talking to bankers. We see the low interest rate environment continuing. That's going to help our market of high yielding assets. The lesson from last year is that investors are cash rich, and they're sometimes quite urgently keen to spend the money, which is always welcome for an auctioneer. And the key to those numbers is sustainable rents, whether they're long or they're short, sustainable, how affordable the rents, and can they add value? So they are the drivers of demand. Thank you for listening to that. I hope it's useful. Delighted to ask any questions, and I'll hand you back to Richard.
Thank you, George. So as George says, that pretty much concludes what we wanted to talk about today in terms of where the market's been and where it's going. And now it's time for you guys, if you want to ask some questions. I can see some have come in, but perhaps Ben, Zoe, are there any questions for George and I?
Yes. Hi, Richard, George. Question for Richard. Will you be going back into the auction room anytime soon?
Thanks, Zoe. Question I get, and we get asked an awful lot. Look, we want to go back to the room, but we want to do it when it's safe to do so. So it needs to be a safe environment for everybody, and where everybody's comfortable as well. That goes for staff and buyers and sellers, of course. We will be waiting to see what the government guidelines are going to be. We're way down the pecking order in that sense. We may be deemed as an event because we have anywhere between 500 and 2,000 people through our doors, depending on the size of the auction. So it needs to be a safe environment. If it involves flow testing and other things, that obviously will give us some challenges. But we reckon we'll be back as soon as it's safe to do so, possibly the end of this year, if not beginning of next year, is where I think we'll be.
Thank you, Richard. I've got a question for George.
Okay,
George, are you seeing a widening yield spread between those deemed essential retailers and those non-essential retailers, you know, that were forced to close during the pandemic?
Yeah, that's a good point, actually. I mean, when I prepare these presentations, clearly the numbers you're looking at are sales, and some of those non-essential retailers are, you know, in the positions and in trading positions where the rents and the businesses might have failed, and certainly the rents have been challenged. So yes, it's about the location probably. We talked about the examples of the C stores, essential retailing, the B&M, something they're essential retailing, they've held up. Non-essential has suffered. It's a combination of the rent not being paid, nobody knowing when that genuine repayment's going to happen, but also the rental value, and it's something that's been very much ingrained in the market. What is the rental value? Very, very hard to assess tenant demand in some of these locations, and again, the lending community will know all about that. So there's a huge disparity. Not just it's the occupier; it's a lot to do with the occupier. Because if you remember, I talked about sustainable rent. Can this business afford the rent? And a lot of the simple example is a C-store, a supermarket. Yes, they can, but you know, selling fashion items when you've got nets going online and beauty going online, it's very hard. So yes, there's a huge yield gap, but it's all about ultimately the tenant demand and where will that rent stabilise and once again become a growing income stream that it isn't at the moment.
Thank you, George. A question for Richard. At what point is a lot too large to go to the auction and would be better sold by way of private treaty?
It's a good question. It's a hard one to answer directly. It depends very much on what you've got. I mean, I think it's fair to say that you can get £500,000 lots that might not be suitable for auction. You get £200,000 lots that might not be suitable for auction. 90% of our catalogues are full of properties which the first resort is auction, and it's the best method of sale from the outset. So I wouldn't necessarily say it's a price point. You know, over the past 12 months, and certainly through my career, we've had the last 12 months between the two teams, we've probably sold almost 200 assets of £1 million or more. The largest lot commercial guys sold on an auction contract was, as George mentioned earlier, 10.5 million. I think the largest lot ever sold at auction is over 20 million. So it's not necessarily a price point. I like to look at it as looking at each asset and actually analysing your buyer profile before you make a decision. You know, if your buyer profile is someone, you know, the lower end of the market, that's end user, going to be in a chain, needs a high street mortgage, got to sell their property, then auction's going to have a bit of a challenge there. Equally, if it's a large site where there's a lot of scale in terms of the number of units you're building, and your buyer profile is going to be a housing association or a major house builder, they're not set up to perform in those parameters of auction. So it's unlikely that's going to be the right place to put it. So it's not down to value, I'd say. It's down to actually analysing who your buyer profile is and can they perform in the parameters that an auction provide.
Yeah, I'd agree. I think the buyers of Reading will enable you in a short marketing period. You're not going to release sometimes a great deal of development value where it's real long term and there's lots of planning issues involved, but there's relatively straightforward assets, well managed. It's about the information, and the digitalisation I've mentioned is if you've got information and you can publish it really simply and really clearly and really quickly for the buyers, they're very receptive, they can move very fast. So lot size, you know, we've sold, as Richard said, over £10 million last year in one lot, £130 million assets in the last 12 months. It's about, is the information good? Is the sometimes is the value questionable? Everyone can have a different view of it. But buyers, we saw, and I think with these shopping centres, we're selling quite a lot of these now. There's a tremendous depth of demand, and while we're one of our biggest office buyers, suddenly want to go and buy a shopping centre. That's called diversification. It's very counter-cyclical, but he's very keen, and again, he's published a story on that himself. So for our market, it's about proper marketing, depth of marketing, starting with good information, and then the lot size. Clearly, 5 or 10 million pounds is probably enough, but we just give it more time. That's what we do. That's how we get around it.
Thank you, George.
Another question about offices, I think. I saw it come in.
I'll get on to those. We've got a question here for both yourself, George, and for Richard, because it affects both your markets. How is the eviction moratorium due to unpaid rent being received by the private investor? And has this affected their appetite to purchase or to sell their assets?
Yeah, I mean, I can, from our perspective, in the commercial sector, we did that survey before Christmas, and the buyers weren't that alarmed by the eviction moratorium. And I think I mentioned earlier they saw the last 12 months as buying opportunity. Clearly, it's not ideal, but the reality is our buyers are portfolio based. So most of the residential income has stayed consistent. If you've got non-essential or smaller lot sizes, so if you've got essential retail on small lot sizes, a lot of that rent has been forthcoming, because you remember the government has given quite substantial grants to small business owners. It's when the city centre shops at £100,000, £200,000, £300,000, £400,000 a year, they haven't started paying rent. You've got JD Sports who can pay but won't pay. That's not really, that's a bit bigger lot size than our market is dealing with. But on the whole, I was quite surprised that people aren't too concerned, because debt costs are low, spread it across the portfolio. Although if I ask them now, 6 months later, I have a different answer. What have your buyers thought, Richard?
It's similar but different in the same breath, I suppose, for the residential sector. We're not dealing with covenants there, but I think there's been far less fallout from tenants not paying rent than perhaps you'd think. But again, the main reason really driving that, I suppose, is the furlough scheme. You know, people are being paid in some respect, and that's filtering down to the landlords. How it's affected how people behave, I alluded to it earlier on, in that some investors will have a preference to try and buy something vacant, because then they can control the quality of their tenants and do the background checks that make them comfortable with that tenant. Those that are buying ready-made investments to hit the ground running seem to be in the main demanding more information. They want to see a track record. They want to know more about the tenant, if there's been any voids or rent reductions for COVID. So really it's two things: a bit of a shift in people wanting vacants, and those that are buying investments, they want, and George talked about it earlier, more information, de-risking things and having a better understanding of what they're inheriting when they buy it.
Thank you. A question for both of you. Where are you seeing buyers coming from?
I love that.
George, do you want to go first?
Yeah, you go first, Richard. Yeah.
Okay. Nothing's changed fundamentally for us. You know, a larger portion of the buyers that we find are domestic. It's a mixture of private investors, private individuals, even end users, owner occupiers, and some foreign investment, depending on what we've got. And I haven't seen a monumental shift in that. There still is some foreign money there. We're still selling to foreign entities, which is great, but the majority is domestic. I suppose the only real shift and trend we've noticed is that we see probably more new entrants to the market. So whether that be end users or whether that be novice and new investors. And I think in the main that certainly happened right at the beginning of the pandemic. For the first 6 months, we noticed it more than ever. And I think that's probably because there's often this, safe haven of property, and in particular the safe haven of residential property, because the majority of people understand it. It's easier to understand to the layman. And when other investment sectors, and not just in property, aren't performing or a little bit unpredictable, again, there's a flight to quality and people coming into the property sector again. And that's what we've really witnessed. But predominantly it's domestic, but there are a lot of new entrants all the time. It's harder and harder now to predict who might buy things and what angles people have got on things, which is great. It just means the higher you send it and the more you market something, the more interest you get, and you get people competing. So it's ever changing. George?
Yeah, this is one of the greatest pleasures of the job which I do, is looking at an interest list and trying to work out the whys and wherefores. I mean, I mentioned that the shopping centre we sold in Dumfries was bought by one of our regular regional office buyers. It shows you how difficult it is sometimes to predict. Like Richard, I would welcome the return of the overseas buyers. A lot of them are represented in London anyway, but they have been unable to travel, and that's been it's entertainment but good for the market to have a different view. We've been lucky enough to do a few portfolios this year of pretty much old-fashioned high street single unit shops, as you'll have seen, the Santanders and the Boots. In some of those assets, the old people I've known forever have said, I've got to do something. I can't sit at home and do nothing. I need to buy something, and I bet I'm going to overpay for it. I mean, if you've got, keep coming back to the portfolio, because they have largely got portfolios that are producing income every month, and they are terribly bad at sitting on cash, which is great for an auctioneer, and it does create liquidity. So it's very hard to predict, but I think the key is that it's always a mixture of the older, more established buyers and the new entrants. I think we're looking, and Ben will tell you, something like was 17 to 20% of new buyers for every auction hadn't bought an auction before. They've got to be brave to do that in the thick of last year, but we were finding them, and it's interesting. Love talking to them, and every auction there's some new people involved, which is great.
Thank you, George. Ben, Zoe, any more questions?
Yes, a question has come in. We've got a question here. Is your team, and this is actually aimed at George, is your team seeing more commercial stock, in particular offices, coming to the market? And what has demand been like compared to 2019?
Yeah, I mean, in the office sector, we are, if I'm honest, I think we are seeing more offices. I don't think we're not seeing a rush of them. Not all of them are getting to the catalogue because they're very hard to price. I think if you're, I mentioned the added value aspect of the PDR, that's clear, and that market's very established. Can this convert easily? I think in the more secondary locations, some of these offices, they're quite hard because the tenant numbers haven't really, they've probably gone down the last 12 months because people are uncertain to commit. So that is a difficult sector. We are selling, as I've shown, but it's something that still needs to find its feet again after the pandemic, and when it will be, I don't know. But as I said, the chance to change them is very welcome. Change the use with Class E, etc. is very welcome, and I think that people are talking about even things like Airbnb and service offices as well as a residential mix when it comes to a bigger building. So that's quite interesting. But yeah, not everyone clear where the values are.
Thank you, George. Ben, Zoe, any more questions?
Yes, we've got a couple more. Another one for you, Richard. Will you be printing catalogues again?
Yeah, we do get asked that quite a lot, but not as much as we used to. I think it's really unlikely to do that, to be honest with you. We've operated, by the time we go back to the room, it could be 18 months of operation without the need for hard copies. Everything's online now, and I think what's really important to note is that obviously a catalogue's a snapshot in time. By the time you get to the auction, it's historic data, as much as most lots change throughout the marketing process with additional information. So it's something which we're pretty confident we're not going to revisit. I think the market's happy. We've got quite a unique app out there, which is a live catalogue you can flick through, which has got more take up than the hard copy ever did, and the hits we got on the websites were huge. So I think that's highly unlikely we'll do that. And not to mention, obviously, carbon footprints and being green, and the responsibility as a firm we have and as people we have to reduce our use of paper and whatnot. So I think it's unlikely, Zoe.
Okay, and one last question here, and it's aimed at George. George, what is your opinion on high street retail and shopping centre future prospects?
Gosh, I thought we'd come to the end. High street retail is, it's very hard to predict. It comes back, the investment value of what we sell is down to tenant demand. In a lot of cases, that's very hard. I mentioned we have sold a number of shopping centres and continue to do so, and it's very interesting. Everyone's different interpretation. These businesses have to have stores to continue to trade and give profits to shareholders. So I think with office buyers, other buyers looking at shopping centres, they're indicating perhaps that the bottom has come for that market. There are some difficult high street assets. And I think that is uncertain for a lot of them, particularly the bigger ones. There's no question. But as an auctioneer, we can find a market for them, I think, Ben. And I think you'd expect me to say that. I think going back 5 years, we did have an index of data, so we could do an A grade, a B grade, or a C grade retail. And because we sold quite a lot of leases with 5 to 10 years on unexpired, we're selling less and less of that because they aren't there. So it's very hard to have an index in our 650 examples every year. It's very hard to really take a theme, but we can give it a go. But we need that retail base to bottom out. I had breakfast with a client last week. Actually, he was challenging some of these renewals, which one or two of the tenants who haven't been that great to the landlords are just wanting 50% discounts across the board, and he just said no. On 2 occasions, he said no to one of these terms, and the rent was, they were offering 25,000. He actually, in 2 lettings, he got one done at the passing rent, and another one was 5% ahead of the passing rent, having said no to the tenants who wanted a 50% discount. So that's encouraging. That's only 2 examples, but it only takes, a bit like the landlords kicking back on the Clark's CVA. You know, you've got to remember these tenants have to have units, have to have outlets to trade. It's not all going online, of course a lot of it has, but perhaps if we are reaching the bottom, that'd be very welcome, and where we can re-establish what a rental value is, and that'll help numbers, and that'll help valuers and liquidity. At the moment, it's upside.
Okay, thank you, George. I think, is that all the questions now, Ben?
That's all the questions we have for you.
Okay, well, I'm conscious of time and people's time is precious, and we've kept it under an hour, which is no mean feat for 2 waffling auctioneers. Thank you for your time and for joining us. Thank you for your questions, and again, thanks to Ben and Zoe for fielding those questions as well. Say an interesting year and no doubt an interesting times ahead. We've got 2 auction catalogues out at the moment. The Commercial Guys on the 6th of May, Resi on the 13th, so you can see what we've got out there at the moment. Like I say, thank you for your time.